So every investment lately seems like a bad investment since every investment looks like it's crashing. But in this video, I'm going to show you guys how to invest and stay prepared for times like this. So that way you can invest without having to worry about it and take advantage of the market opportunities that arise. And these 3 simple concepts that I'm going to go over in this video are exactly what you need to know to stay ahead. Starting with number 1, which is why it's important to keep up with your finances. Making sure that you have enough money saved up for your expenses, which generally 3 to 6 months is quite enough. Me personally, I like to keep around 6 months of my monthly spendings. That way I know I have a big enough cushion if anything were to happen. But if you are going to go lower than 6 months, then 3 months is actually the minimum that I would go for your emergency fund. That way this gives you a little bit of a cushion to fall back on if you were to lose your job or anything of that sort. Now, if you want to make it easier for your preferred emergency fund, then living below your means actually helps you because that gives you much less that you actually need to save, and that way it's a lot easier to survive. It's common sense. The less you live off of, the less you're in a need to actually survive, and that way it's a lot easier to just grow your emergency fund to your preferred goal. But the main part about keeping up with your finances is actually reviewing your finance every single month or every single week if you preferred. Just make sure that you're able to track your income, your saved amount, and your expenses all in one month, and that way you see what you need to cut back on, and that way you're able to track and adjust your budget if needed. The other part is having money set aside for any opportunities that come. So setting a small percentage of your income, maybe something like 5% minimum, would actually help you take advantage of opportunities, because that way you have the cash set aside just in case if you actually need it. And feel free to actually raise a percentage if you want to and have the necessary budget to actually allow for a 10% savings, which I prefer to as sideline cash. I think around 7% of your income is actually a good balance between having too much sideline cash and having a little bit, because you still want to maximize your return in the market. And if you have too much setting aside, then you're not going to max out the potential that you could be earning on that pile of cash. Because if you were to do the opposite and actually invest all of your sideline cash, then one, you will not be able to take advantage of market dips, and you actually want to have the flexibility to put it towards whatever opportunity that you're seeing. So whether you're all invested into stock and you might want to invest into gold, you would have the necessary funds to do so. And it also could be used as an extra emergency fund if anything were to happen to your main emergency fund. This would be pretty much a backup of a backup. So yeah, keeping up with your finance gives you the opportunity and flexibility to actually stay alive during market crashes. And like I said, you'll be able to take more risks than anybody that doesn't have a sideline cash or isn't actually controlling their finances correctly. And you also wouldn't need to sell any investments, which could save you from a loss. Real quick, if you guys are enjoying this video and you guys want to follow my financial journey, then please hit the like button and subscribe down below. Thanks, and let's jump back into this video. And the second thing that I want to go over are market drops are a good opportunity for every investor. And remember, good safe investments are something that are going to increase over time, so that's something that you should not be worried about. Whenever you see big dips or drops, that just means a lot of people are selling at that current time. And I don't know if you guys heard of a saying that you never lose until you actually sell, which you obviously have to be able to determine whether your investment is a meme stock or is it actually a real investment, which meme stocks are actually driven by hype while real investments are driven by structure. Now just keep in your head that whenever you see a market dip is actually a good opportunity to buy in or buy more of. A great example that I heard is if you have a shirt that you really want and it's $50 and the price ends up dropping to $30 for the moment, and you know that it's going to go back up eventually, wouldn't you take that deal or sell since you can get at a discount and it's probably the best buying opportunity? Now just imagine this with anything you ever want, not just a shirt. Now imagine this with something that you know is going to go up in value over time, which is pretty much the market dips. This is always why you're going to hear that smart investors always end up buying more, and that the market dropping isn't the risk, it's actually selling that's the risk. That is why I still continue to buy more shares, even though that the market pulled back a little bit. I just know that I'm getting a really good deal at this point, and that when it shoots back up, then I'm going to have a bigger gain. Now the third and final thing that I want you to start doing is actually automating your investing, and this is something that you can start doing right away. In fact, I actually auto invest every single paycheck. So every Thursday I have money coming out from my Robinhood account, my Roth IRA, and my crypto account, and I actually don't even know that it's actually being auto withdrawn. This just makes it a lot less stressful and a lot less to worry about. That way I'm not sitting watching price movements, because when you log into the accounts and you see the price movements, you're like, dang, I should have bought something else. But all the price movements are temporarily. So that's why if you do anything today, I would just automate your investing and make sure that you're investing into real investments, no meme stocks or anything like that. I personally invest into ETFs and like mainly S&P 500, large cap growth stocks, and technology and semiconductors. I would just do a little bit of research on what you want to invest to and just make sure that it's safe and you see growth opportunities in it. Because knowing that your investment is going to increase over time and actually go up is just going to make it a lot easier and stressful. Just make sure that you're actually investing investing in for the long term. That is how I was able to grow my portfolio to over $100,000 just by being consistent in auto investing. And it's pretty easy to set up the auto investing on any investment platform. If you go on their settings, you should be able to see an auto investing option for you to invest. And if you guys don't have anywhere to invest, you can find my Robinhood link below, which is what I use to invest. So with the auto investing, just set it up so that way you're investing, and you can also just focus strictly on building your income. And if you just do these 3 things that I went over in this video, your portfolio will grow just fine. And 2, you'll increase your assets over time, which is what happened for me. Now, if you guys want to see my net worth update for the month of April, you can click somewhere right here. Like, comment, subscribe, and I'll see you guys around the channel.